That's actually true for actually both for food delivery as well as quick commerce.
Okay, before, what do you use?
I use Zomato. I'm a loyalist.
Zomato loyalist?
Zomato loyalist.
Okay. And what's the reason though? I mean, it's fascinating to understand, right? Why does somebody choose one or the other?
I think, so I thought
You don't like the color
I have
orange?
two reasons. No. Wow, risky things to say.
Dangerous. The behavioral change has been made already.
Yeah.
Right? Where inherently the Indian consumer is lazy, for lack of a better word, and we want things delivered to our doorstep right now. Right? How many things can you have on one app?
Look at Paytm.
Paytm's now going the opposite way, right? Yeah.
But I think it's also about reaping out the benefits while you can. So incubating in a way till there is some maturity and then maybe hype off or whatever.
Right.
There may come a point, there may not come a point. Fundamentally, what has happened is that super apps have not worked in India.
Exactly.
They worked in China, but they've not worked in India.
Right. This episode of Taking Stock is brought to you by Paterson. All right. Hello and welcome to another episode of Taking Stock. This is a weekly podcast where we pick one company, we pick one stock and deep dive into it. Today we're talking about Swiggy. And I'm assuming a lot of the conversation is going to be revolving around the Swiggy versus Zomato debate. So let's get right into it, right? So the first thing, and this is something that's caught my eye right away when I was going through the article, that Swiggy as a company, in spite of being the market leader, they were the first sort of entity to get into this space, and in spite of that, they are currently losing market share quite rapidly. Is that true?
That's actually true for actually both for food delivery as well as quick commerce.
Okay, before, what do you use?
I use Zomato. I'm a loyalist.
Zomato loyalist?
Zomato loyalist.
Okay. And what's the reason though? I mean, it's fascinating to understand, right? Why does somebody choose one or the other?
I think, so I thought
you don't like the color
I have
orange?
two reasons. No. Wow, risky things to say.
Dangerous.
No, so two reasons. I think one is that Zomato from the very beginning, because you're for food delivery, I'll start with that. Because you're opening the app to look at reviews.
Okay.
Whenever you're going going to try a new restaurant.
Back in the day. Yeah.
Or even now, for example, if I want to check the rating of a restaurant or I want to check the
menu.
But you
can do that on maps and stuff nowadays.
No, but then those pictures come and all of that. No, the standardized format is better on a Zomato.
Zomato, right.
So I usually check restaurants before going on Zomato.
Right.
And that's why also end up ordering on Zomato itself.
Correct.
And that was actually, now that you speak about this, back like when I was covering the internet sector in Motilal Oswal as an analyst, at that time there was 50% almost near market share for both of these guys. So I was of the hardcore belief at that time that this creates a sort of foot in the door when it comes to users, because they are inherently going on to Zomato to check the restaurant's ratings and reviews, or the menu, or the pictures, or whatever. So if they're doing that, then they capture the user in a much more healthy manner when it comes to food.
Correct.
Versus a Swiggy.
I think Swiggy's got this whole dine out thing, but they've got into that space very recently.
But that's also for booking tables. If you
so they've got the same thing. They've got reviews, and I think I'm not. I know for a fact they've got pictures and menus and everything. I'm not sure if they've got reviews.
Like if we decide to go to a new place, I will first look it up on Zomato. And
definitely. I think that is the consumer behavior that is there throughout, right? That most people today, before going to any place, want to read a review or want to check the menu, or like outside India, this is a very common phenomenon where if you're walking in a city center of a European city, right, the menu is always outside the restaurant.
That's the most touristy thing to do.
No, the restaurant keeps the menu outside the restaurant. But no, you know why they do it?
So you can check and
you can check if you can afford it or no.
Yeah, of course.
But that's what I'm saying. Anyway, we've digressed.
So that loyalty switched to Zomato now as well, and Blinkit hence, because then you get used to the interface as well, which transfers. And I'm not too anal about how much time it takes, etc. I'm not in a hurry usually, so I'm okay. So anyway.
This episode of Taking Stock is brought to you by Paterson. So Swiggy's lost market share and they're losing 2,100 crores a year.
That's the number they're losing or burning. But despite that, number which they are burning in cash, they're losing market share.
Okay.
And I think they're losing market share in both the businesses, food delivery as well
And
as quick commerce.
Okay.
Food delivery was pretty much they started the business back in 2014. Zomato sort of was of a very strong opinion at that time, saying that we'll let restaurants deliver by themselves. We'll not go into delivery because it's not economical.
Correct.
So there were several conference calls at that time, not conference calls, they used to release shareholder letters or something. So that used to explicitly state how unit economics don't work in the delivery business.
Right.
And it's great that people are open to changing their viewpoint and to such an extent that they're now leading the entire space.
So you're saying initially the belief with Zomato was that we will just be sort of an connector, a platform where people place the order and the restaurant then fulfills the order. Yeah. Oh, right.
And then they moved into themselves also getting into delivery. And now they're at a point where Zomato is leading the market. And if I just look at from FY22, Swiggy was still probably say 49%, Zomato would be 51 types. I'm ignoring all the other players, smaller ones, right?
Right.
And by FY25, you're in a position, or FY26, you're in a position where Swiggy is at about 44%. And Zomato's captured that 5 percentage points.
Correct.
This is not so dramatic because there is only 2 players and several have come and gone.
Right.
The dramatization happens on the quick commerce front, where again Swiggy was the one who was the category creator or started
Instamart,
basically in 2020.
Right.
Zomato came in later with Blinkit. And as we speak, if I have to, for example, exclude Zepto, which is the third major player in this, if I have to exclude Zepto and say only Blinkit and Instamart, what is the share between them in terms of revenue? Swiggy or Instamart was at say 36% in FY23.
Okay.
So Swiggy's revenue divided by Swiggy plus Zomato, Swiggy, Instamart plus Blinkit.
Correct.
Right. That was 36%. As we speak, it's come down to about 27%.
Right.
So they've lost a good 10 percentage points on an already smaller base when it comes to quick commerce. So it's not only market share that they're losing, and that's where it ties into what you're saying about losing 2,100 crore.
So I'm assuming, and you said this I think also, right, that every player in the quick commerce space is burning money.
Yeah.
So I don't think that's an abnormality here.
No, but depends on who's losing how much.
Correct.
So these guys are losing much more than
the others,
compared to say Blinkit at this point in time.
Right.
Just to probably again give you some context in terms of how those numbers look, or we'll come to it later. No, I have the number, sorry. So Blinkit would be doing a contribution margin of about 3%. Instamart does a minus 5% contribution margin.
So what exactly is contribution margin?
Contribution margin basically is your revenue minus variable cost divided by the revenue. So how much you're taking excluding the variable cost.
Understood.
And then contribution margin minus fixed cost will give you something like an operating margin.
Understood. Okay.
So it's a measure to tell you how much contribution margin or profit you need to make in order to cover for your fixed costs and more than fixed costs.
Okay.
So this is a particularly useful measure when it comes to high capacity capex businesses or high fixed cost businesses.
Right.
Because in this business, for example, you have to set up a lot of dark stores and set up your infrastructure.
Right.
And then revenue follows your maturity of the store will also increase over a period of time. And then they'll become more profitable.
Right.
So in this case, you need to focus on contribution margins first to figure out how much of that cost I need to cover.
Correct.
And
before you start increasing money.
So for example, right now, if I look at, there's a differential between how many stores Swiggy and this one, Instamart and Blinkit also have.
Right.
So Blinkit obviously with the market share difference has more stores.
Okay.
And
is there a major difference though?
It's as good as the market share differential.
It'll be in the same ratio.
Because the other metrics are pretty similar. So average order value, frequency of ordering, all those metrics are pretty similar. Now that these businesses have been operating for 3-4 years. The difference is only in terms of, say for example, number of stores. When it comes to revenue, when it comes to profitability, there is a difference in several other factors which we can...
Understood. Yeah. This episode of Taking Stock is brought to you by Paterson. Makes sense. So what went wrong with Instamart? I mean, when you say that they had the first mover advantage, they were the first ones to get into the space. And firstly, I mean, we probably forget that this space is only 4 or 5 years old, right?
Yeah.
So quick commerce only started in the pandemic. So what's gone wrong in the last 4 or 5 years? It's a short span of time at the end of the day.
See, I don't think anything's gone wrong as such, because what happens is when a space entirely is new and it's growing very fast,
Right.
everybody grows fast. Then I think it becomes a question of who is growing faster and who is growing more efficiently.
Right.
So even if you look at the entire pandemic time, so between 21 and 25, if you look at Zomato's, and this is the food delivery business.
Correct.
Right?
Okay.
So Zomato's food delivery GOV, which is the gross order value, which is something like a GMV, gross merchandise value, plus gross order value.
Right.
That grew at a 42% CAGR.
Okay.
Swiggy, on the other hand, grew at a 31% CAGR.
Right.
31% CAGR is not bad. None of the companies that we've covered in the past have shown such growth.
Right? True.
But still, you're calling it a failure, or you're saying that what went wrong. We're using that language for.
But also, I am assuming that the pandemic spurred a behavior change where people couldn't go out. So naturally, everybody was ordering more stuff.
Yeah. So now food delivery business growth has come down to say 17-18%. It has normalized because the market has also grown in depth,
right,
and breadth and whatever. But still, that's not a low number, right?
Right,
20% is still very high. So what went wrong is they just went slower, right? That is one factor. So it didn't fail. It just failed to scale as quick as a Zomato did.
Right.
And that's the one thing, right? And the market share differential is not too large. It's 5 percentage points.
Correct.
What happened in the Instamart business is that I think it was an overall function of how the environment also was.
Okay.
With Zepto also. So now it's not a 2-player game. It's a 3-player game. So with 3 players, I think there was intense competition in terms of burning money for aggressive growth and offering a lot of discounts. And not charging much of fees, which now have started handling fee and all of that.
Convenience fee and all that.
So there, to gain market share for an Indian consumer who's still sensitive to these prices, and who's sensitive to discounts, these companies usually resort to taking that route to gain customers.
Correct.
If you're already on the back foot when it comes to market share, you want to go more aggressive by burning more money.
Correct.
So it's a little bit of a vicious cycle there.
Right.
So what's gone wrong and why the contribution margin is low today is because the average order value is okay. So there was a difference there as well. We'll come to that. But primarily they're burning more money than they're making.
Understood.
And till the time they don't catch up or they're not satisfied with their market share, that will continue happening.
Understood.
So that's where it has broadly gone wrong.
Ever, like an ongoing thing? Because tomorrow, if Swiggy gains a little bit of market share by burning more money.
But that's not little bit, that's the difference. So right now, for example, if a Blinkit is at a 50% market share, Instamart is at 25.
Correct.
So there is a very large differential between the two when it comes to market share.
Eventually, you're saying if there's 2 players, they would sort of settle at anything close to 50-50. If there's 3 players, they would all settle at anything around a 30% market share.
You never know, or they want to get the third out. Look at what's happening in telecom.
Right.
I mean, it's a bad parallel, but there is a parallel in terms of just
with your Jio and Airtel.
Yeah. So where is Vodafone today?
Correct.
So it's not necessary that 3 players choose to settle for market share.
2 might want the 50-50% or 2 might want to dominate the market.
Sure.
Fair enough. Makes sense. And okay, so now since we're obviously talking about Swiggy in this podcast, we won't go much into Blinkit and Zepto and everything. But what is Swiggy currently doing? And I mean, I'm assuming they've made a few changes. They've rejigged their entire management. They've gotten some new people. Is it showing any positive signs currently?
So one thing is they got this guy called Amitesh Jha on board, who was in Flipkart. He spent some 13-14 years there and he's joined in. And apparently he's like a shrewd supply chain man, where he's great at extracting unit economics out of sheer discipline and operations. And that is pretty much exactly the opposite of what Instamart had been doing so far.
Right.
So the problems were 2-3-fold for Instamart, which they've kind of re-engineered in a way and they're trying to solve. So one of the things is that they realized that Blinkit's stores, for example, were double the size of Instamarts.
Okay.
The dark stores
Right.
from where the deliveries happen. So while Instamart was at about say roughly 2,500 square feet, Blinkit was double.
Right.
Now what Swiggy's done is they have taken this a notch higher.
Huh.
Launched something called megapods also, which are 10,000 square feet stores.
Okay.
And in general, increased or focused on at least the incremental dark stores to be of a larger size.
Right.
Now, why larger size, right? One is that you're able to give more SKUs.
Correct. So is it okay? Let me take a guess here.
Yeah.
Right. Is it that things that are okay? So let's say something like a bread is ordered very often, high orders, high demand, etc. So it's kept in the smaller warehouses which are present in multiple locations. But something like little more novelty, right? Something like an exotic chocolate, which is not ordered that often and doesn't have high demand, is kept in those megapods. Is that how it works?
Primarily, yes, that is one factor.
Right.
But also, I think, yeah, you're right. I mean, the lesser ordered will be, but that is an efficiency game.
Right.
I think that comes as stage 2.
Okay.
Stage 1 for Swiggy was to plainly increase the SKUs.
Okay.
Because a lot of people, while we spoke about UI or whatever being our preference of choosing one over the other,
Right.
When it comes to a lot of the SKUs that are non-grocery, people would be making a choice depending on where the item is available.
Absolutely correct.
So if something is
I
available,
remember reading recently where you've got PlayStations being sold on Blinkit and stuff.
No, PlayStations are a very off case.
Right.
But if, for example, I want a frying pan right at home, my handle came off.
Correct.
I need a frying pan. If it's not available on Swiggy but on Blinkit, I will take it from Blinkit.
Yeah,
right?
you're
Because
not gonna
my
think
cook's
twice.
coming in 10 minutes. I need the frying
Correct.
pan. And that happened with, like, for example, you run out of you're somewhere, you run out of underwear you want, or you run out of kurta for the Diwali party.
Yeah, exactly.
It's about where it is available. Now,
Right.
that can be in a megapod, that can be in your normal store. That is an efficiency or operational game that they'll play.
Correct.
Which is also relevant. But I think primary is that Swiggy or Instamart primarily just included or got more SKUs in to, one, increase their visibility and them as a choice for the customer.
Right.
Number 2, also, if you remember the Vishal Megamart discussion, it has a very interesting parallel here,
Right.
where anything to do with groceries has the lowest margin.
Correct. And things like clothing, etc. have
clothing,
better margins.
fashion, apparel, general merchandise, all of them have higher margin.
Right.
So a lot of the contribution margin that we're talking about, which is negative for an Instamart versus Blinkit, does not only come from operational inefficiency or whatever. It comes from number 1, average order value.
Right.
Because groceries will have a limitation in terms of order value.
Correct.
This will be higher AOV typically. So the same variable cost, which is, for example, transporting is the major element.
Right.
If you're able to transport goods worth 2,000 versus 500,
it makes
automatically your contribution margin increases.
Correct.
So one is average order value. Second is the category mix itself. So less of groceries, more of other stuff. And that can be anything, right? It can be high frequency as well.
Yeah, I think all of these three players, right, when it comes to quick commerce, I think especially I would say in places like a Bangalore, Bombay, Delhi, major urban cities, the behavioral change has been made already.
Yeah.
Right, where inherently the Indian consumer is lazy, for lack of a better word, and we want things delivered to our doorstep right now, right? So that behavioral change was probably the easy part of it, right?
Yeah.
But also I'm talking about a behavioral change where it's not just groceries anymore, right? I'm assuming when quick commerce started, we as consumers also looked at it as, okay, I need groceries, I need fruits, I need vegetables, I need cigarettes, I need chips. My mom's gonna, sorry mom. But yeah, I need chips, I need, all of those things. It gets delivered. But now, as you said, it's changing where we are now looking at it for clothes.
Yeah.
People are now looking at it for, I'm in a different city, I need shoes to go for a run. You can just order shoes immediately. So I think people are also now looking at it as different, where it's now slowly changing that anything I need can come.
Yeah.
And the sky is the limit, to be honest, when it comes to this.
So
right?
a couple of numbers to just highlight there is that, for example, their SKUs increased from about 8,800 to 35,000. That's a near 3 to 4x jump in SKUs. The non-grocery mix was earlier 26%, it has come down to 9%.
Right.
So that's the change that you're talking about when it comes to behavior. And at the same time, given the change in management, there's a lot of efficiency gains as well happening.
Right.
Where, as again, one of the points that you highlighted was where the SKUs are kept.
Correct.
Right. So a lot of efficiency gains can be multiple factors to this.
Yeah,
It's like
I'm sure. Yeah.
That can be a 3-hour podcast.
Right.
But so all of those factors have now, coming to validation, resulted in probably a couple of metrics to highlight here. One is that contribution margins for Swiggy went from about minus 5.6% to minus 2.6% in just 3 quarters.
Okay.
In the last 3 quarters.
Right.
At the same time, they've given a metric that about 25% of the Instamart dark stores are currently operating at positive margins.
Okay.
So those two are positive metrics when it comes to saying that how much they were bleeding. I'm not saying they can stop bleeding. They will continue bleeding, but at least that bloodshed will reduce.
Right. This episode of Taking Stock is brought to you by Paterson. Makes sense. So now, okay, we all know, we've spoken in a little bit detail about quick commerce. We all know about Swiggy and Zomato's sort of food delivery model. But there are a few other initiatives they're getting into, right? As a company, Swiggy is getting into a few other initiatives. One thing that I know is events and the whole ticketing platform and everything. We spoke about Dine Out a little bit earlier.
Yeah.
So is there any other initiatives that they're sort of venturing into?
So one of the things is that, at a very fundamental level, one of the key differences between what Zomato does and what Swiggy does is that Zomato's been launching individual apps for everything.
Correct.
Blinkit is a separate app. District is a separate app.
Yeah.
Zomato is a separate app. Whereas that's not true for Swiggy. Swiggy's integrated everything into one
super app.
So intuitively, I think there is a very fundamental difference in terms of their approach, their overall outlook on how they want to approach this.
Right.
That may have at some level worked for Instamart in the last few quarters in terms of just saying that it's easier for an Instamart to switch customers from Swiggy by just placing themselves there.
Correct.
Because they have near equal market share when it comes to food delivery, but a differential when it comes to quick commerce.
Yeah.
So I think what they are thinking is that you'll be able to get a transmission from there and benefit from a lower cost of customer acquisition. Cost will be lower. The CACs are going to be lower.
Right.
And that to some extent has worked in terms of the last few quarters. So that's one initiative, not initiative, but that's a fundamental approach difference. Right. The other thing is that both of them are sort of in a very similar business when it comes to supplying stuff to restaurants as well.
So I know Zomato's got this Hyperpure. I think it's called Hyperpure, right?
They've got Hyperpure. Swiggy's got something called Assure.
Okay.
So that is a significant portion of the business, but look at that as a distribution or a trading business.
Right.
So that's not something that, although it is sizable, if I look at the numbers, that makes up for about 30.
So it's low margin, you're saying?
Yeah. It's
your
about,
margins are extremely low on this.
Or negative also right now, but yeah. So it must be about 45-46% of their total revenue.
Okay.
It's that large.
Right.
But when it comes to valuation, it will hardly make up for anything.
Correct.
Similar with Zomato. And they are equally sized, I feel.
Right.
The other thing is, on that, this thing,
the other initiatives.
No, the uniform platform thing.
Yeah.
One number that I forgot to mention was that 65% of Instamart's new users have come from Swiggy.
Food delivery, yeah.
So that way they've achieved about 75 to 80% lower CAC compared to competitors.
Correct.
So that's an advantage.
But I know we'll digress a little bit on a different tangent, but do you think this is sustainable? Because eventually Swiggy and Zomato are companies that are going to go into, they've got a particular demographic of customer that they sort of captured, and everything that demographic needs, they're going to slowly venture into, right? How many things can you have on one app?
Look at Paytm.
Paytm's now going the opposite way, right? Yeah.
But I think it's also about reaping out the benefits while you can. So incubating in a way till there is some maturity and then maybe hype off or whatever.
Right.
There may come a point, there may not come a point. Fundamentally, what has happened is that super apps have not worked in India.
Exactly.
They worked in China, but they've not worked in India.
Right.
And that is true of anything, right? Like right from financial services all the way to consumer-facing businesses. It's not really worked. So they may take that route at some point in time. Simultaneously, what has happened is, if you look at this itself, like the other initiatives that you were talking about, there is one which is called Bolt, for example, which is basically 10 to 15-minute delivery
food
for
delivery,
food, right? So that has been launched. There is a couple of other stuff as well.
But I'm assuming it's very low scale, not
not really. So if I look at the 2Q FY26 revenue split, 46% of revenue comes from the B2B supply chain services, which is
Assure.
Yeah, primarily Assure, and then there is one more logistics business, which is more like a distribution business for FMCG brands, which was acquired by them some time back. Next would be food delivery, which is at 35% of total revenue. Then is Instamart, which is 18%. And then the rest of dine out and whatever will be
Understood.
So that's the overall split.
Makes sense. Now, in terms of scale, right? So even, I know this is more for Swiggy, and I'm assuming at some point we'll have a different podcast for Eternal. But there is a bit of a difference between Zomato and Swiggy when it comes to scale, right?
Massive.
So what's that about? Because from an outsider's perspective, you would always assume it's a duopoly. And they're sort of equal.
But that's what, if you look at the overall revenue, right, there is a difference in terms of what their operating levels are. Like, I'll just give you, for example, food delivery,
right,
where they're not so far apart. If I look at the FY25 numbers, Zomato did about 8,100 crores. I'm just rounding up numbers here. Swiggy did about 6,300.
Okay.
Right. So they've, as I said, lost a certain market share, but they're close.
Right.
When it comes to quick commerce, Blinkit did 5,200 crore in FY25. Instamart did 2,100 crore.
Oh, so that's less than half.
So there is a massive difference when it comes to scale on that front. And you asked about the dark stores, right? So for example, Blinkit has about 1,500 dark stores. Instamart has 1,000.
Correct. So it's in line with the scale.
So it is quite proportional that way. The difference, if I have to, that's the overall scale difference, which is also appearing at a overall revenue level.
Right.
The difference to the extent of food delivery. So the other businesses are more or less equal or whatever.
Right.
But that's the difference. The larger difference, I would say, is not focus too much on revenue, but start focusing on the EBITDA, and that's where you see cracks.
Understood.
So the burn that you spoke of, the annual 2,100 crore burn, that is reflecting massively when it comes to Swiggy's numbers versus Zomato. If I just have to look at, for example, a broker estimate for say FY26, Eternal's pegged at about 1,250 crore.
Right.
Sorry. No. That's...
it'll be more, no?
No. Revenue at 34,100 crore. Swiggy at 22,900.
Right.
EBITDA at 1,250 crore for Eternal, which is positive.
Right.
Swiggy is at a minus 3,300.
Right.
So EBITDA margin for Eternal would be about 3.7. For Swiggy, it is minus 14.4.
Right.
And that is the projection for FY26.
Yeah, they're not close. They're not close. Yeah.
They're not close. They're far apart when it comes to profitability. And that is where the difference is. So if you look at, for example, even a lot of people talk about the valuations of Swiggy being at a 40% discount to Zomato. One factor for that discount is obviously the scale difference. Where if I look at, again, a two-player market, Swiggy would be at 44% of the total when it comes to food delivery. In quick commerce, it is at about 27%.
Understood.
Right. So there is that about 40-ish% difference when it comes to scale.
Correct.
A lot of people say that if they had to converge, that discount will reduce. Right.
Understood.
However, look at the difference in profitability, which is so massive.
Right.
So in that case, a convergence seems very, very difficult because this is a very large difference which will continue. Right. So if I sort of even try to figure out when they'll reach profitability, I think the runway is pretty far.
And again, I know we're going into Zomato, but the trajectory for Zomato is an upward trajectory in terms of their profit. So
for
this is
both
going
of them, it is upward.
Okay.
So it is from a positive, it is upward for Zomato or Eternal.
For
Swiggy, it is from a deep negative. They must have reached their bottom and they're sort of inching up from there. So they're not at rock bottom anymore. Also, one more factor is to understand the profitability metric a little bit better, right? Because we do this in every podcast, just a business model sort of rundown, right? So say, for example, there is 100 is the gross merchandise value or order value.
Okay.
Right. We'll cover the food delivery business first. From an FY25 perspective for Swiggy. So typically 25.2 will be the revenue. 25 will be the revenue out of 100.
Okay.
So you're selling goods worth 100.
Right.
You're getting 25.
25, yeah.
Versus for quick commerce, it'll be roughly 15.
Okay.
Difference is because 15 is being charged only from users here or from brands. Whereas here, every restaurant is paying.
Restaurant is also paying plus the, correct.
So there is that difference. Then there is the variable cost. Right? Variable cost is roughly 18, 19 for both in that sort of range. And hence the contribution profit for a food delivery business is currently at 7.
Right.
Whereas for a quick commerce, it is at a -3 or -4.
Right.
Right. And then below that is the fixed cost.
Right.
Fixed cost, for example, in a in a food delivery business, it will be roughly, it's come to about, it's reducing only because as your above metrics go up, fixed cost remains the same, operating leverage kicks in.
Right.
So that would be as a function of maturity and business model at around 4.5, 5 right now for food delivery. But for quick commerce, it is at 9.5.
Right.
Also because dark stores,
yeah, exactly.
And inventory. So it is operationally much more heavy compared to a food delivery business.
Understood.
So if you hence look at the EBITDA, the food delivery business in 2Q FY26 did a 2.8%. Whereas the quick commerce business did a -12.1.
Oh.
So that's the kind of difference we're talking about when it comes to operating metrics. So when you talk about, say, for example, when is it that they'll break even or whatever, right? If I look at FY25, Instamart did 2100 crores, Swiggy did 6300 crore. Now, Instamart is growing at 100% YOY.
Right.
Swiggy will be growing at, say, 20 to 30% YOY.
Correct.
So, the higher bleeding business is gaining scale faster to an extent where by FY27, both will be equally sized.
Understood.
Until then, if this is still negative margin, you forget about the overall business being EBITDA positive.
I didn't understand. Explain the last part.
So till FY27, if they're still bleeding money in Instamart, and the profit in the food delivery business is not so much to cover up for that,
they will start bleeding overall.
They'll continue bleeding overall till then, but the losses will narrow down.
Understood. Okay, makes sense. Makes sense now. Yeah, that makes sense now. This episode of Taking Stock is brought to you by Paterson. Anyway, so I think the major pressing question in every podcast is, what's the valuation?
So see, it's very hard to put a when they say that 40% discount to Zomato, for example, what they essentially people do is they compare the price to sales metric.
Okay.
Because in this, when EBITDA is positive for one, negative for the other, barely any EBITDA, it's very hard to base your valuations on the EBITDA.
Right.
And that too in a fast changing environment. So what's happening is that I think you'll have to slice the business up into two parts. And essentially, because the food delivery business is more or less similar, let's say you give a very similar multiple to both Swiggy and Zomato.
Okay.
Right? If we have to, again, do this exercise for food delivery, because of the higher scale of Zomato, naturally the valuation will also go a little higher.
Correct.
You'll maybe not give them the same valuation, you'll give a little bit of a discount to Swiggy.
Right.
So that is one thing. You get food delivery business out of the way.
Okay.
Not too much of a differential there. So the valuation difference will depend on how much scale difference there is. Mota moti.
Correct.
Plus a little more.
Fair enough.
Now when it comes to quick commerce, the ideal way to go about it is do a DCF. Because you don't have visibility of it turning profitable in the next year or two.
For our uninitiated audience, what is a DCF?
A discounted cash flow model.
Okay.
Basically, you project the cash flows for the next 10 years and look at the cumulative cash flow value as of today.
Fair enough.
That's one part.
Right.
Second is you assume the business continues into perpetuity after that.
Right.
You take that value also, add it to today's value. Combined value is the value of the business.
Understood.
In very simple
Fair enough. Understood. Yeah.
So if I have to again look at, so my primary assumption in that could be that Swiggy will continue probably either losing market share, or because of the new initiatives, at best case they will stem the market share loss. If that has to be the assumption, profitability still comes much later for Swiggy.
Correct.
And hence the discounted cash flow valuation for that business, for the quick commerce business, comes to much lower value. So I'll just take, for example, one of the brokers that we, one of the reports that we referred to. Their DCF, according to their assumptions, my assumptions may be completely different, but their assumptions, the quick commerce business for Zomato, the value comes to about 2.4 lakh crore.
Okay.
For Swiggy, it comes to only 60,000 crores.
Okay.
That's because you're discounting the operating cash flow or the net cash flow after.
So that's about a 1/4 essentially.
Yeah. So even if there is not, again, I'll go back to saying that even if there is not much of a, I mean, there is a differential, but if Zomato's market share is 50 and Swiggy's 25 in the quick commerce business, the losses are much graver.
Correct.
And at the end of it, when you're doing this DCF, you're going to take how much the net cash flow is.
Right.
Net cash flow for the business may still be far away compared to Zomato, and hence the valuation difference is so much.
Right.
And that kind of comes down to the overall value as well. Now, I don't want to give numbers in terms of what the overall value comes to, because DCFs are extremely sensitive to inputs.
Right.
But overall, the call then you have to take in terms of valuing it or taking a view is that if the food delivery business is more or less similar, you're taking a call, it boils down to what happens in quick commerce. In quick commerce, it then boils down to if they're able to make or turn around the business and get a decent operating cash flow from it in the near future, which at this point in time doesn't really
seems unlikely. Too far-fetched.
Even if it is far-fetched, the valuation discount has to be lucrative enough or has to be tempting enough for me to say, okay, now it's looking good. There's a price for everything.
Correct.
At a 40% discount to Zomato, is that price there or not there? That's for one to think about.
Fair enough. Makes sense. But okay, I have a question, right? So when you did the whole DCF thing, again, I'm not from a finance background for anybody judging, but you said that they valued it at 60,000, the 60,000 crore and 2.4 lakh crore, right? So that is basically Swiggy's value should technically be 1/4 of Zomato's value. Is that what it means?
Valuation-wise, yeah.
Valuation-wise, yeah. So now, if Zomato, so what I'm trying to get at over here is if Zomato has a 40% premium over Swiggy.
Discount. Sorry, premium. Sorry.
Premium, right? Yeah. Zomato has a 40%, Zomato's price 40% more than Swiggy. That is still, in that scenario, Swiggy is still sort of overvalued?
That's for you to judge.
Okay. Am I going in the right direction?
You're on the right track.
Yeah, okay.
Fair and enough. Not in terms of, so I'll just give a certain layer to it, which is, for example, Instamart's size, say in FY26, will be 1/3 of Blinkit when it comes to revenue.
Right.
But what you're supposed to look at is the difference in profitability, not the revenue.
Understood.
Because the blood loss for Swiggy is much more than Zomato.
Correct.
So even if they're 30% smaller compared to Zomato, the losses may not be 30%.
Right.
One is in loss, one is near whatever.
Correct. Makes sense. This episode of Taking Stock is brought to you by Paterson. All right. So anyway, let's move on now. The last part of the pod, which is the community question. Every week, and this question is very apt for the company we've chosen, right? But basically, every week we pick out one question from all the messages that we get on our social platforms. And this week we've got Steve George from Calicut, who's asked a question which says, there's a lot of new age companies coming out with their IPOs. Is it a positive sign, and should we invest in them?
See, there's a difference between these companies getting glorified because of fundraisers, for example. Before they get listed, they get very, very glorified for raising X amount of money and at a certain valuation and all of that. And it's a great...
But you've also got, sorry to interrupt, but we've also got a lot of these companies whose promoters have become celebrities now in a sense.
Yeah. So, and the vanity comes from the fact that, itna valuation hai, so you've become so rich, etc.,
Right.
etc. But the public starts taking it much more seriously when the company is listed, because every fundraise results in a dilution of equity.
Correct.
Right? Because you're issuing fresh shares.
Right.
If it is issuing fresh shares, it will dilute equity.
Right.
When someone else's equity dilution is happening and the company's growth is happening, you're on the sideline, you're like, hey, great.
Yeah.
What a guy. What a
Right.
star. When your money starts getting diluted,
Correct.
That's when it starts hurting you.
Right.
So if you look at like a lot of these IPOs, despite them doing IPOs, they are doing now QIPs very soon after the IPO.
What's the QIP?
Basically institutional placements.
Okay.
Where they're raising more equity.
Fair enough.
But now they're already listed.
Right.
So they'll raise more equity by diluting shares, and several institutional investors will participate in that fundraise.
Understood. But it's not open to the public.
No.
Huh.
But there is dilution happening.
Right.
And you can say that the dilution, I am okay with X level of dilution because the money I'm raising will give me an ROE which is higher than the dilution I'm doing.
But that's always speculation at the end of the day, right?
I mean, it's your call. I mean, it's a judgment call. It's your whatever.
Right.
It's a fundamental call. It can be anything. But point is that QIPs, for example, now Swiggy is around the corner of doing a QIP.
Right.
And Ola is around the corner.
Right.
Eternal and Ixigo have done it in the past. So these companies have sort of come back into the market to raise more money, which makes a lot of people question whether they're even a little more prudent about capital allocation or not.
Right.
Because they are entering businesses and aggressively ramping up and growing 100% year-on-year businesses which are draining cash.
Right.
And they don't have enough cash on the books to keep draining that money in order to get market share. That behavior is okay when you're not listed and when you have a bunch of shareholders who are all okay with it. But retail investors start to take it negatively when...
Yeah, and it's the public's money at the end of the day.
I mean, see, their choice, they've invested, right?
Right, that's also true, yeah.
I have consciously, for example, stayed away from this entire space during the bloodbath because you guys fight. Why should I participate?
Fair enough.
When the dust settles, I'll put my money in. That's been my view.
Right.
So retail investors can choose to crib and say that, boss, what is this? This is not right. Don't participate. No.
No, I mean, I'm assuming I've seen this on social media in the last 6 months, right? Because we're working with Paterson and sort of managing Paterson social media. But I'm assuming you guys, the wealth managers, and when you deal with your HNI clients, you must be seeing this a lot more, where there is an increasing sort of trend where people just want to invest in companies that are popular.
There is, yeah.
Right, and I think that trend is increasing because your decision making isn't really backed by any fundamental or expert calls, right? It's literally backed by...
It's backed by intuition, backed by what you see, and that viewpoint is very limited, I feel. So like we said in the initial part of the discussion, we assume it's a duopoly, but there is such a large difference between these two companies as well. So analysis is a must in any case.
Right.
So I think it's great that new age companies are getting a platform to raise more money. There is public participation as an option available now.
Right.
Because when they're not IPO'd, you can't participate in the wave at all.
Correct.
So for who wants to participate, it's great. But I think you've got to be doubly careful of what you're getting into, because these metrics are very different from the metrics we usually track. Like a lot of the terms we use today themselves are so different from the usual jargon.
Right.
And they're different because they don't have the profitability. So we use different terms to try and dissect and gauge it. So great that these companies are coming in, but I think prudence-wise from an investor standpoint has to be double or triple. You've got to be really on your toes and be careful about where you're investing.
Makes sense. Sounds good. I think that's all for this week. Thanks everybody for listening. We will be back next Tuesday, and we have new podcasts coming out every Tuesday. And every Tuesday we will pick a new company and sort of dissect it the same way we did today. Thanks a lot for listening.
Thank you.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.